Baby, we're back to all-time highs. There really only are two kinds of stocks in this market, ones that are interest rate sensitive and ones that aren't. But today and for the last week and month, it doesn't seem to matter. All stocks go to the frigging moon, which tells me that we are in a place of irrationality as I try and break this down in a very sensible way in this video, because oh my God, if you asked me if I was bearish on the market heading to this Fed meeting, that answer was yes. Like I was making videos on the correction is here. We saw some stocks correct pretty dramatically, but the Fed came out and kind of literally fulfilled what people were expecting. Hey, we're not cutting rates anytime soon because guess what? Inflation isn't at our 2% target. That doesn't mean we're not going to cut rates. We still plan on 3 rate cuts this year. Just we're going to push it off. I mean, anybody really could have anticipated that to some varying degree. Not to the extent that I thought the market would explode the way it did, though. I mean, the markets, now from the all-time high of 2022 are up damn near 10%. You take a look at the year-to-date correction that we had. This was the correction. We dropped about 1.1%. If you bought that correction, you're up 2%. Congratulations, year to date, you've made a 10% return in barely the first quarter of the year. We haven't been through a full quarter yet. We're up 10%. If this happens every quarter, we're going to be retired here very soon here, folks, which is why it's kind of easy to imagine it's fairly unsustainable. I mean, the S&P TSX on the Canadian side of the border is now up into the green. We're finally hitting an all-time high here. So congrats to the Canadian investors. Congrats to the U.S. investors. Congrats to everyone that just keeps buying, like I tell you to all the time. And I'm not going to stop buying, even though the data we're about to get into is relatively bearish, because if you take a look at the price to earnings multiples, which is kind of getting out of control here, especially if you take a look at the last 5 year. I mean, the last time we've seen levels this high were during the pandemic when things started to get irrational, right? And you have to go all the way back to 2008 prior to that before we saw levels again that were this high. And if you take a look at the S&P, I really want to talk about the top weighted holdings when it comes to Microsoft, Apple, Nvidia, Amazon, Meta, Google. That's going to be the primary focus of this video because I think they really exemplify the disconnect in valuation today. The Qs, even though rallying 1.1%, and the Qs largely represent stocks that are a little bit less leaning toward interest rate sensitive, right? Like these are stocks like Nvidia and Google and companies that have been crushing it, right? So, but even though with the Qs trading at, a 35 PE right now, where the historical is usually around 29.30, SCHD was right in line with it. I mean, the SCHD ETF, after just talking about it yesterday, is up 1%. To put that in perspective, even the S&P 500 isn't even up a full percent yet. Yet the Qs and SCHD are up over 1%. And both of these are dramatically different kind of companies. So it's kind of interesting because if interest rate cuts aren't coming anytime soon, why would interest rate sensitive stocks that SCHD holds like Home Depot and those companies go up? I mean, their earnings aren't going to be affected. I mean, anytime in the near term anyways. And you take a look at the broader markets here and it's just, wow, lots and lots of green. It looks like we're starting to correct a little bit. Google's coming down a little bit here. Apple obviously kind of makes sense. Apple's kind of still speculative here on where they're going. But still, let's kind of frame this a little bit. Let's talk about the individual holdings because Microsoft is one of my favorite exemplifiers. Like Microsoft has kind of returned back to a median, like a norm on revenue growth that it saw in the past, like typically playing around that 12 to 15, 17% revenue growth. And that's kind of where they're back. Now, there's a lot of anticipation for guidance here because even when you go back to this period here, which was like 2020, 2021, but really the more nominal period was between, basically any time for the last decade from 2013 onward, they were trading at a 12 to 18 on the higher end, maybe even clipping 25% sometimes with revenue growth. But when you take a look at that price to earnings multiple, even during those more nominal growth periods, it was nowhere near close because again, you go to 2017, sure, there was some fluctuations, but typically it was around 18 to maybe a 25 times multiple. We're at a 38 times multiple right now on Microsoft, and we're only just back to nominal revenue growth for them. Seems a little extreme. Apple hasn't had any real revenue growth. I mean, they've been stuck in this downtrend for quite some time now. And the last time they had any real growth was during the pandemic and more nominally during that 2018 time period. But we can see that even during the pandemic, they touched 35 times, but they're still trading at this crazy 27, 26 times multiple for a company that has no revenue growth ahead of it right now, right? And earnings are barely starting to go back up as they squeeze margin out and do share buybacks. What I think is really happening is these companies, these chip makers like Broadcom that have been really moving their way up the S&P 500 have taken by storm the price to earnings on the broader markets. And it has nothing to do with the overall economy because companies like Apple and Tesla and companies that are largely affected by interest rates and how much money people have to spend have nothing to do with the chip sector. The reason that Nvidia can pump is because all the money Amazon and Microsoft and Apple are bringing in and net income is just going out the back door to Nvidia. I mean, that's literally what's happening with these chip makers because these companies know the future is in this AI technology, even though they might not be making a lot of money off AI tech today. I mean, we don't have self-driving. Robots aren't running around the world right now. And yeah, we're slowly seeing the implementation of, a lot of AI software, which is truly revolutionary. It's not really hitting the bottom line of companies like Adobe, especially when we take a look at Adobe's guidance, right? I mean, so the only companies really driving value are these companies, but it's insane. It's so largely unsustainable when Nvidia, yes, out of nowhere, we've seen this massive revenue jump from companies buying these chips. And that doesn't mean they're going to stop. Obviously, we could have a huge runway of chip buying here, but this company is trading at 74 to 75 to 80 typically in its price to earnings multiple, which is, again, in that upper level of usually when it's growing. So at these levels where there's no way they're going to sustain this growth, like they're just not. I have such a hard time believing in the next 6 to 12 months that Nvidia is going to be growing at the pace it's growing, and eventually it's going to hit parity. And people are arguing with me about this, and I just don't think they understand math or basic compound effects, that things just can't grow at these clips. The S&P cannot be going up at a 10% clip when companies' revenue is not growing at the same pace. It's just unjustifiable, right? It's just common frigging sense. And the same is true for Nvidia. You cannot have a to the moon like stock in perpetuity forever, because eventually it can just not build facilities out as fast as it can grow sales. It's just not going to happen that way. I'm sorry. These companies only have so much money to spend, and it's going to hit parity sooner or later. You look at a company like Amazon, which is a good reflecting company on how much the economy is spending from a revenue growth standpoint at the scale, when they're making 500 plus billion in revenue over time annually. But you can see they're not growing like they were, right? I mean, the revenue growths have definitely slowed down, which makes sense at the scale that they're at, right? But their price to earnings is largely unjustifiable because this company typically doesn't show earnings. They move money around a lot. Very hard to justify. But, typically for where they're trading today, is it favorable? I like to think it's more favorable, but still quite an expensive company, right? You look at a company like Meta. Meta's come back to a 24% growth rate, not where it was in the past, growing at a 50% clip. But, its revenue is starting to go back to an all-time high, and it's getting back into double digits where it used to live, which is nice to see. But is that favorable at a 33 times multiple, which historically is the highest that it's seen basically since 2017, maybe 2019 when it hit that a little higher area when the earnings started to correct a bit. So, I mean, you'd have to go back to 2017 in Meta's stock price where they were growing at a 50% clip to get a PE multiple like this, yet they're not growing at that clip today, but they're trading at that same multiple. So just think about that, right? Look at Alphabet. Alphabet's probably one of the only favorable stocks that I really like for good reason, because they've kind of returned to a nominal double-digit revenue growth, not in the 20 percentile where they were back in 2017, 2018. But you got to remember in 2017, 2018, they were trading at a much higher multiple, whereas today Google's one of the few companies that are trading at a much lower multiple than their historical average during some of their growth period. So you can kind of get a sense that Google might be trading at a much better discount today. But you kind of got to take all this and digest it and realize, guys, that the market just can't keep doing this. Like, we have to get some astounding earnings for Q1 to justify, this really high 28 times multiple. And obviously, a lot of cyclical events are driving this up. It's just that people have to take a breath here and realize that, yeah, we might be sitting in somewhat of an AI bubble, or if it's not a bubble, we're definitely sitting in a very expensive territory where a lot of forward-looking growth really has to start coming into play, because one bad event like the pandemic that we saw, or an interest rate cycle, or something that happens can really pop this and lead to a downsizing event. Not that I'm worried about this, because I never care about if the market's bearish or bullish. I can be bearish on the market and I'm still buying. Like, I'm always buying stocks because I just don't know. Nobody really knows. But I can look at the data like this and get a sensible and reasonable understanding of kind of where I feel that we're at in this kind of cycle, right? But again, I've never sidelined the markets. Even during the pandemic crash, never sidelined the markets. I obviously move my portfolio around. I adjust some things here and there depending on how I feel, but I'm never going to sideline the market. I don't think anybody should, because over a 20-year period, you would have never lost money buying the S&P 500. And that's probably going to remain true into the future, and seems to continue to remain true. Just understand, guys, that we are in a very weird, irrational moment, and you kind of got to just take a breath and not be too giddy about buying really high-flying tech companies, because even me buying Tesla's expensive. But again, keep in mind, it's like a super tiny percentage of my portfolio still. And I'm looking at buying dividend ETFs here in Canada and SCHD and continuing to build that aspect, because that's what's been propelling my portfolio to a continual all-time high. And though those companies I still think could see a cyclical correction if they keep running, I just like having that broad-based diversity, because it eases some of the stress knowing that I'm collecting some dividend income if the market corrects. I have extra income to always be reinvesting. But again, I feel like I'm a squirrel trying to find his nut right now. But what are you doing in this market? I'd love to know in that comment section below.